G'day and welcome to the Investor Motivation Podcast. My name's Robert Gowdy and this is...
Amy Lehman, everybody.
G'day, Amy.
Sounds like I'm on a talk show or something.
Yeah, close to.
Yeah, podcast talk show.
Yeah, that's a good idea. I think it is one of those things. Thank you very much for joining us. Today we're going to chat about market volatility. It's been based on a case study. And I did a short version of this on last week's YouTube. So that's the 3.5 minute version. But today we're going to go a little bit deeper about volatility, the psychological side of it, and probably the last 12 months we've seen volatility, but the markets have been positive, so people aren't so concerned.
Yeah, definitely we're in a bit of a recovery phase compared to, the COVID pandemic and when that hit, and when you do think about volatility, people do think of those extremes, and but the day-to-day can seem extreme sometimes as well.
Yeah, and I think that's where we are seeing volatility is completely normal and happens all the time. But even when the markets are going up, it's still volatile.
Yes.
It just doesn't have the big legs down, which means it's in the news and really worries people. But before we get started, we better do the acknowledgement of land.
Yes. On behalf of the Investor Motivation Podcast, we would like to acknowledge the traditional custodians of the land on which we record this podcast and pay our respects to elders past, present and emerging. Awesome.
Thanks, Amy. So it's probably worth sort of seeing where this conversation, the actual case study started, and then we can sort of go into, I suppose, some of the, understanding why volatility happens, which I didn't go through in the YouTube video, which was obviously only 3.5 minutes worth. But so we've definitely spoken about probably over the last 2 years where we had really extreme volatility. We had the COVID crash, and then we had the huge run up afterwards, and then we had 18 months of bear market.
Yeah.
And that bear market was just far more stressful for people than what I saw even during the GFC, the tech wreck of 2000, and also the COVID crash where the Aussie market dropped by nearly 40%.
Yeah, right.
I felt as though the anxiety was much higher in that gradual grind down where there was the Russian-Ukrainian war. Yeah. There was just so much negativity.
Yeah. Do you think that's maybe because with the COVID pandemic there was an instant drop and everyone knew the exact reason why, whereas the gradual correction because of that rally afterwards was a little bit more of an unknown, and that's why people are more scared? Or?
I think so. I think it's the uncertainty of when will this end, where will this, interest rates going up, inflation and all these negatives. And I think it was, absolutely. I think the unknown is the bit that scares people. And I remember, this is going back to 2003. So in the run up to 2000, when the internet was just a thing, and internet companies, internet startups were, had no revenue, definitely no profit, but were going through the roof. And so, they were, too optimistic, too greedy. Yeah. And the market just, the US market, the NASDAQ went up to blazes.
Yeah.
And then, of course, it worked out that no one was going to make any money at this stage. It was early.
Yeah. And
a lot of companies that were worth possibly billions, it's going back over 20 years, actually didn't make much.
Yeah.
But the bear market, so after that sort of came off, rolling into all the way to, it was sort of mid to early March 2003.
Yeah.
So on the tail of the tech wreck was the build-up of the second Iraq War with Bush Jr.
Okay.
And there was this build-up where are we going to go to, are the Americans going to go to war or not? We didn't really know, and the markets hated that uncertainty.
Yeah.
And it was around that, and I did my first margin loan for myself personally at that time, and it was the 9th of March.
Before that uncertainty, or?
It was during the uncertainty, but it was, I nearly timed it within a week that they actually went to war. The first missiles went in. It was obviously a horrible event for the people involved.
Yeah.
But what the markets did, you'd think after the first bomb was thrown that, markets would collapse and be in, fearful mode. Well, guess what? The uncertainty was gone and they went up.
Wow. And so that was too much pessimism maybe and uncertainty, and then it happened and it was like, it doesn't affect me as much as I thought it might. and then is
Well, and I think from there, markets don't like uncertainty.
Yeah.
And I suppose the tech wreck and perhaps that sharp crash with COVID, where people said, well, we know what it is, we know what's causing it, it affects everyone, so we battle on and we don't overthink it. But that grind that we saw in the last couple of years, where there was all these things out of people's control and there was uncertainty. So I think that's, really stresses people. And the client that I'm thinking of, watches his portfolio intently.
Yeah.
Highly intelligent man, loves watching. It's, smart person, loves investing.
Retired or?
No, not retired, still working, but later part of the career.
Yeah.
The ebbs and flows during that downward spiral just caused real stress.
Yeah.
And although he's in the last 12 months, his portfolio, the markets have recovered.
He's
still feeling the effects of what happened previously.
Yeah, he's got that high number. The portfolio was one day many years ago in his mind, and anything below that isn't quite satisfying. And
that's right.
Yeah.
And I think we can't discount the feeling that people have and it's been proven psychologically that the downside, the feeling we get, the emotional feeling, the downside, if 1 to 10, it tends, an extreme feeling.
Yeah.
Some of these, particularly retired men, because they're watching more often, they're watching the portfolio valuations, that they were feeling, very, not happy about the markets and stressed. So it was 10.
Yeah.
And if that same client now has, say, had a 15% return as markets rebounded, you'd think he'd be happy at 10 as well, but I reckon he's probably 2.4.
Wow.
And so the feeling's not there.
Holding onto it.
That's right, and that's where the downside emotions is far stronger than the upside.
Yeah.
And that's why there's a hangover.
Yeah.
But where we got to was, we were trying to work out, well, what options do you have? And we were workshopping it, advisor and client. It was a really good discussion.
Yeah.
Should we save that for the latter part of the discussion, or should we jump in, to say what causes volatility?
Probably work through the conversations that you had. I'm assuming that's where you would have started with that client, is explaining what market volatility is.
Yeah, and I suppose market volatility, and I think a good way to discuss it is that every market trades every working day of the year.
Yes.
So we know what Microsoft, Apple, and all these amazing businesses are worth on a daily basis.
Yeah.
But if we have a look at the place that we work here, where Consortium Private Wealth is situated, I don't think this property is sold for probably 10 or 15 years.
Yeah.
So we don't know
the value.
We don't know what the value is, but if it was to be sold 4 times per working day, every day over a whole year, the difference between the top price and the bottom price, there'd be a pretty big gap, depending on how optimistic people were, how friendly the banks were, how much they'd lend, interest rates and so on. But you don't see that. But in the share markets, because they're so liquid, which is a real benefit, they trade all the time. And so if markets get fearful, if
people get pessimistic,
and then greedy, that's what causes the volatility. And that's the
every day.
It can be a benefit. I used to get really stressed that there was so much volatility in these downtimes, and people would become stressed and emotional and want to sell their businesses, and it used to worry me. And I thought, geez, media, can you stop? Investing is a long-term game.
Yeah.
But then I didn't worry about it because
when people are fearful and selling and it's going volatile downwards, that is potentially an opportunity.
Absolute opportunity. So I think that's where I used to be very negative on the media, and now I say, look, blow it up. Talk it up, scare people, and myself and my clients will be buying as we go.
Yeah.
But that's what I suppose volatility is all about. What's the next point here? Why would we put up with it? Is the obviously I've forgotten I wrote this, but why would we put it up with it? And that is because we can access some of the world's best businesses.
Yeah.
And those best businesses can provide over a long time frame a tremendous return, as we've seen for a lot of our new clients and also our very much long-term clients. And if you can put up with short-term volatility, because I know over the long term that Microsoft are investing probably not far off $20 billion per year to make things better. And if they keep doing that over a long period of time, then they'll provide, growing revenue and profitability will dictate what something's worth in the future.
Yeah, that reinvestment into themselves is going to make the business valued higher, and they'll produce better things, sell more stock.
Yep. Yeah. So
it's a flow-on effect.
Yeah, and essentially we're saying that the market volatility is it's normal, it's there, get used to it.
Yeah.
But the people running these businesses are not looking at the markets; they are working on the business, improving services and products.
Yeah.
Cool.
So with your client, you explain market volatility, what it's caused by, why we put up with it, and then what were his feelings, or was he in agreement with what you were saying? Or
I think ultimately an absolute in agreement.
Yeah.
But it doesn't stop the feeling.
Yeah.
That this is still a stressful thing, Amy, and so that's what I say. I know provides some comfort.
Yeah, it sounds. You hear it. It sounds like common sense. Yes, I understand what you're saying, but I still feel like shit.
Correct. When the markets go down, you feel like crud, and we work so hard, and as we get closer to retirement, think the stress is high for those people that are retired or not far off retiring.
Yeah.
So, and that's this scenario, and I think that's where, regardless of what I say, you still feel.
Yeah.
And so I'm very mindful of that. And this is where I think we're worked out as financial advisors, why we know we know tax law, we're rich tax agents to, as part of incidental financial advice, we know superannuation legislation and the taxes around that, the benefits and everything. We know all that, but a big part, and investing, that's the hobby.
Yeah.
But I've worked out that where we are so valuable for people is when it hits the fan, when things go bad and people feel and get really emotional, that's when they need us the most.
Yeah.
And that's where we help them make the right decision at the toughest time.
Yeah.
And I've used that quite a bit.
Yeah.
And I think that's where...
The tough decisions during the tough times.
Correct. The right decisions, tough times, all the above. Because, psychologically you just want to bail because, or how far is it going to go down? Can my investments go to nothing?
Yeah, the fear sets in.
All those things kick in.
Yeah.
That loss aversion, and will it keep going down further?
Yeah.
Now, when people feel like that, I see that as a flag to go and buy.
Yeah.
Yep.
Challenge that thought pattern in your brain and get rid of that loss aversion bias and try and just work through it.
Yeah, and I think that's where talking to your financial advisor in those really tough, emotional times, that's when you need that person more than ever.
Yeah, you need that.
Yeah, because I think any financial advisor will look good when the markets are going well.
Yes.
It's easy, everyone looks good, but it's not a function of what we're doing as financial advisors. We set the asset allocation, we get the right structures to save tax, blah, 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 blah. But then markets will do what they do over time.
Yeah.
And I think it's worth understanding that, ultimately when we're investing into businesses, we're investing into humans to do good work, to improve their business, to improve their services and products.
Yeah.
So it's human endeavour. So if you back people, because no one goes into a business to run to the ground.
No.
So you're even before you were a partner in this business, Amy, you're saying, Rob, we need to do a podcast.
Yeah.
Here we are. And hopefully that's helpful and improving.
Yeah. People value that.
That's right. And educating people, which, in turn builds trust and helps us longer term.
Yeah.
So that's, it's backing people to do things over a long, but it takes time and years to implement those changes.
Yeah, exactly right. That's the long-term game behind it. And when you are purely acting on emotion, as a lot of clients do, it definitely go see your advisor. Go see someone who will look at it without that emotional filter and look at the statistics of the business, what they're doing going forward, read their reports and really realign yourself with the business's values. And ultimately, if they no longer align with your values, that might be when you do think about, stepping back. But if they're still a great business and it's just, external factors like the consumer sentiment, people are fearful, economic conditions, then it's hold steady.
Yeah. And how have you, obviously, with your client base, Amy, what have you felt over the last 12 months? Has it, reviews became easier as markets got better?
The 12 months, yes.
Yes.
Yes, definitely. That has been things have really steadied off a bit and people are more understanding that, yes, times are bad. COVID was hit. A lot of clients that we've had during the downturn of COVID are very happy. But if you invested, at the beginning of COVID or even at the beginning of that rally up and when it was overvalued after COVID, those people have been, suffering that volatility a lot. So it depends on the client, but it's interesting having those different experiences with clients and how they're feeling and
So I think it's some of the strategies that my client and I spoke about, which were sort of, these are not new strategies, but I think one of them's a little bit new and a bit cheeky on my behalf.
Here we go.
And there was 3 strategies we worked on, and I think people always talk about diversification as a strategy.
As in to not feel as stressed by the volatility?
I suppose to limit volatility. But I've seen over the years in the number of crashes that I've been through, that if you say, okay, we'll have some Australian businesses, the industrials here, we'll have infrastructure, we'll grab some listed property over here as well, and we're nicely diversified.
Yeah.
But when things go bad and everyone's scared, guess what?
Everything goes bad. Everybody's scared.
Yep.
Yeah.
Nowhere to hide. So I think that type of diversification doesn't overly help. Won't stop
General.
you. Everyone's scared. And every asset is affected.
Yeah.
So I'll just park diversification, which is really important. It's one free kick that we get.
Yeah.
But the first one we came up with, which is a bucketing strategy, where have yourself 3 to 5 years worth of income for the coming years. So if you need 60 grand a year and you want 5 years worth, you need $300,000 segregated over here. That means that all your other assets can be growth orientated, and for the next 5 years you will never be in a position to have to sell down those assets. And of course your assets that are invested bring in income, which sort of extends the life of that cash bucket, that you'll never be in a sell position. The other option was an annuity. Pick up an annuity that might cover 30, 40, 50% of your annual income. And of course, in both of these scenarios, it's taking money away from an area that can give you a higher return, but into a cash conservative investment. So in both those scenarios, we're doing that. So you might say, let's cover off 40% of our income for our busiest, most expensive time of our retirement at the start, when we're busy and going hard and having fun. We cover 40% with an annuity that costs us 300 grand to do that. And I've never had a client complain about an annuity.
No, well, it would help with that volatility stress a lot, because the reason you are panicked when the markets go down is you think that you've got less money to draw from and receive an income year to year. So guaranteeing 40% of your income, or could be more depending on how much of a stressful person you might feel that you are. It's a massive weight off the shoulders.
So it depends on risk profile, but there's always there's an opportunity cost with these type of investments. You're putting big lump sums into areas that are not going to grow.
You're already invested in the markets generally.
Correct. The world share market, despite all the podcast,
all the ups and downs.
All the ups and downs, the volatility that we see, despite all that, 10, 11% on average over decades. So that's where personally I will back people to run their business as well. So both of those were quite valid strategies, and what we might do for this client is a combination of them all. But the last strategy, the cheeky strategy, was quite simply stop looking at your portfolio.
Yeah.
Don't rebuild it on your phone. Don't log in at the end of each night. Don't look.
Yeah.
If it creates stress, what's the point?
Yeah.
Because you looking at it's not going to change what the guys at Microsoft do.
No. Look at your cash account, I think. Yes, look at your cash account. Is there enough money in there for you to receive your income? If yes, what more can you really want?
Yep.
Let the markets do what they're going to do.
Yep.
Let people get pessimistic and then let them get re-optimistic.
Yeah. And I think this is where, as you said, if you're good cash reserves, we always encourage people to have a good amount of money at home in their own personal accounts,
Yeah.
good cash reserves in their self-managed super fund or their investment portfolios, and annuity if you like, which makes up part of that conservative. But I think people need to understand that we are investing for their life,
Yes.
to their life expectancy. So when I sit in front of a 60-year-old lady and a 63-year-old man, I'm essentially thinking about the next 40 years.
Yeah.
And that gives plenty of time to put up with volatility and allow businesses the time they need to execute and make things better.
Definitely. We sometimes will do this depending on the client scenario, but if we do the risk profile questions and a client comes back as a very conservative investor, but we know, they're 60 years old, they've got potentially 30 plus years to remain invested, and their current cash amount needs to provide income for that whole entire life longevity. We have the power to, educate them and invest them. We'll make them more comfortable with those more growth assets to know that it's got to last them their lifetime. There's definitely that risk of being too conservative and you will run out of cash because it hasn't had the opportunity to grow.
That's right. It's a huge risk.
Yeah.
And I've always said and felt that when we are talking about 20 and 30 or up to 40-year investors or the rest of our lives, that there is more risk in being too conservative over a long time frame.
Yeah.
Having cash reserves, I think it's great. It helps us sleep at night.
Yes.
But having large amounts of cash, more than what's needed, more than that 5 years of income ahead, plus another 5 if you're really conservative. There's risk.
Yeah.
Yeah. And for this client, and it may turn out to be that we use a combination of all three of those. Annuity, a nice annuity, so no one's ever complained, because once you buy the annuity, the provider just keeps on sending the agreed amount each and every month.
Yeah.
And then you have cash reserves, which we're always going to have cash reserves in our clients' portfolios, and then stop looking.
Just stop looking.
Stop looking.
Easier said than done, definitely.
Well, that's right, and I think people feel an obligation that I have to look after the portfolio for the family, so a lot of men feel like that they've got to have that obligation. I had one client, an accountant, said, "I'm an accountant, I have to look." No, you don't.
Yeah.
It's not helpful to look, and it doesn't. It just doesn't. It won't set you up to make good decisions when you're really emotional.
Yeah.
And regardless of how much we educate and tell people about these times that are ahead of them, volatility, bear markets, crashes, it's not till they're there till they really understand.
Yeah, that's right. And, as a young person, I'm empathetic towards these feelings, but I'm not going to realise until I am approaching retirement closer what exactly that feels like.
Yep.
Yeah.
Yeah. Oh, I'm sure it'll be well before your retirement, Amy, when you're invested and you've got money in the market and you go, geez, that didn't go well.
But at the
that
moment,
doesn't feel good.
No, but at the moment I think, I've got the rest of my life to make it up if I have a loss.
Bring on the mistakes.
Yeah. So at the moment I'm, off with the wind with it, but I'm sure when you are approaching retirement a bit closer on it, may feel a bit more of a pinch.
Very good. Any other areas to cover off on, Amy, that you would be keen to think about or talk about? Let's not just think it.
Probably not too much more to say. Well, there's a pretty good stat here that the S&P 500 from 1928 to 2021, so the long term, had 25 negative years and 68 positive overall. And I'm sure those negative years were, some of them were quite negative with all those extremely negative downturns that you've experienced through your life. But the general trend, and the most important thing to do always is zoom out, look at the general trend of the line. If you can draw a line from start to finish, it's generally upwards.
Yes, yeah, and that's
the markets trend upwards.
That's because there are humans that are working hard to make things better.
Yeah.
And I think that is one of the key messages.
Yeah.
And whilst people think, share market and shares, it seems to be sort of, nothing they can relate to. But you do need to relate your holdings back to, I own Microsoft.
Yes.
I own Wesfarmers.
Yeah.
I own CSL. These are businesses ran by very smart people.
Yeah. It's always a good idea to look at the ownership as well of those businesses and how much ownership they actually have on the overall business. And of course, those people are going to do the best by themselves and their family and want to grow their wealth and work hard.
And that information is really easy to find. If you want to go and find out what the insiders, the people running the business, own of the business, just download the yearly or half-yearly report. It's all there.
Yeah.
They have to disclose it.
Yeah.
Yeah.
It's
Fantastic.
A really good one.
All right, I think that's probably a good one.
Yeah.
Good. Thank you. Yeah, thank you very much.
Hopefully everyone enjoyed that.
Yeah, it's a little bit off the cuff, and we need to get back into the swing of things, which we've said before.
Say it again.
We definitely will. But thank you very much for listening. Please know that there's lots of resources on our 540 plus video YouTube channel. We've put a lot of effort into that area as well as this, and it's all about education. On our website, there's lots of free resources, lots of downloadable ebooks, lots of courses on credit cards, courses on superannuation. It's there, free. You don't need to put your email address in.
Yeah.
We're just keen to educate, and if you've got any questions or topics you'd like us to cover, let us know.
Definitely. All right, everybody, enjoy.
Cool. Thank you. Bye.
Bye.